Welcome to Dr. Vijay's lectures on financial statement analysis. Lecture number 2. The lecture currently is on the basic terms of financial statement analysis and right now exactly how to calculate capital invested in a firm, which is called in finance technically as capital employed. A student of basic accounting may be having impression that capital invested is exactly what is represented by capital account. It is wrong. Capital accounts in proprietary and partnership firms shows the owners or partners' share of capital invested. It includes the amount originally contributed by the owner or partners plus profits brought back so far through transferring net profit to capital account. In company accounts, capital account shows only the called up value of shares subscribed by the shareholders, which after deducting calls in arrears is a paid up capital. It does not even include the proud profits of past years unless that is capitalized through issue of bonus shares. Imagine an entrepreneur who starts his venture with 10% own contribution and 90% provided as a term loan by bank repayable over a period of 5 years along with 6% interest per annum. His contribution is say $10,000 and bank loan is $90,000. Can you claim with confidence that the capital invested in the venture is only $10,000? It is no doubt $100,000. Therefore, capital employed in a firm is the aggregate of long-term funds invested over there, including equity and debt. That is all long-term funds, whether owners' funds or borrowed funds. Now, I would like to tell something very important to the learners. Our mission is to impart knowledge for free in ways more sensible to the learners to learn by self at own convenience. Please do not forget to subscribe and share maximum. Presentation in writing on black and white boards suits only the ambience of classrooms. In PowerPoint slides, things are very legible and clear, so we are following it. Students can keep it as own study material even. Please go through the slide now. Read slide 1 very carefully, giving 2 seconds for that. Okay, hope you have read it. Now let us read it together. It may require further clarifications and explanations. Capital employed is a term used in financial statement analysis for the total amount of long-term funds invested in a business firm. It includes both owner's fund or equity and borrowed funds or debt. Equity is a owner's claim, including capital originally contributed plus profits brought back so far minus all past operating and other fictitious losses not written off. Debt is the creditor's claim including all borrowings of long-term nature. Any borrowing repayable after any duration beyond 12 months is long-term. In short, capital employed in a firm is the whole of its long-term funds. I think things are very clear, so let us proceed to slide 2. Slide 2 explains the formulae for calculation of capital employed. There are 2 methods for the calculation. Method 1 is based on balance sheet liability side. There we will consider only the equity part and debt part, that is long-term debts only. We will not consider current liabilities. In case of proprietary and partnership firms, capital account balances plus long-term borrowings. Capital account balances, as we have seen earlier, itself shows the capital contributed by the proprietor plus the brought back profits. And long-term borrowings should include interest and charges pending for long period beyond 12 months. In case of companies, 1 plus 2 minus 3 of the following. One is paid-up capital, both equity and preference. Paid-up capital is called-up capital minus call scenarios. And 2, reserves and surpluses, including premium on issue shares and debentures, and credit balances standing in profit loss account. That is all accumulated profits. And 3, debit balance in profit loss account balance or other fictitious assets. Debit balance in profit loss account means it will appear the asset side of balance sheet under heading fictitious assets in balance sheet of companies, and that whatever is there, that you have to subtract for finding out capital employed. So you have to, along with paid up capital as shown by balance sheet, that is called up capital minus call scenarios. Along with that, you have to add all reserves and surpluses, including profit loss account credit balance. Then you have to subtract all fictitious assets, including profit loss account debit balance, which is there in the asset side of balance sheet. In method 2, it is common. The calculation is common for both partnerships, sole traders, and companies. 2 things you have to add. One is fixed assets, closing book values after depreciation. 2 is net working capital. Net working capital means current assets minus current liabilities. Okay, I think it is very clear. Now let us proceed to slide 3, workings. In slide 3, balance sheet of ABC company as on 30th June 21, which have worked out in our lectures on accounting, lecture number 21, slide 14 is given. Look at the liability side. Do not consider current liabilities. Capital employed is only equity plus debt. Equity is the capital accounts of 3 partners, and debt means the term loans, loan from Dena Bank and loan from Small Finance Corporation. The aggregate of term loans and capital is capital employed. Looking at the asset side, fixed assets plus net working capital. Fixed assets means furniture and fittings, motor vehicles and tools and equipments. Take the total value of that. Then net working capital is current assets, total value of current assets minus current liabilities. So capital employed is fixed assets plus current assets minus current liabilities. Let us read the working in the next slide. Slide 4 shows the calculation of capital employed at ABC Company, a partnership firm, as on 30th June 2021. And method 1, capital employed equals equity plus debt. Equity here is the balances standing in partners' capital accounts, aggregating $741,560. Debt is term loans aggregating $230,000. So capital employed equals $741,560 plus $230,000 equals $979,560. Under method 2, capital employed equals fixed assets plus net working capital. Net working capital is current assets minus current liabilities. The aggregate of fixed assets is $746,610, and current assets aggregate is $744,550. Current liabilities aggregate $511,600. Net working capital is $232,950. Therefore, capital employed is $746,610 plus $232,950 equals $979,560. Okay, now let us proceed to calculation of capital employed in a company. This slide shows the balance sheet of Myco Limited as on 30th December 2018. Based on this way to calculate capital employed, this balance sheet is not complete. Here there is only in liability side share capital, reserves and surpluses and long-term loans. current liabilities is in the slide. On the asset side, only fixed assets are there, current assets is in the slide. Based on this slide part of balance sheet itself, we can calculate capital employed under method 1, that is equity plus debt. Equity here is equity shares fully called up and paid up 400,000. Then reserves and surplus, 3 items: general reserve, dividend equalization fund, and profit loss fund balance. Then there is debt. It is long-term loans, 7% debentures, 700,000. Total of all this is capital employed. Now let us go to the subsequent slide. Let us calculate capital employed of Micro Limited under second method. The fixed assets you have seen in the previous slide. Consider the value of book value of all the 3 fixed assets after writing of depreciation. Then current assets is given in this slide. Take the total of all current assets, subtract current liabilities. So current assets minus current liabilities is working capital, and capital employed is fixed assets plus net working capital. Let us see the working in the next slide. Next is slide 7. The lecture concludes on finishing this lecture. This slide, calculating capital employed at Micro Limited as on 31/12/2018. Method 1. Capital employed equals equity plus debt. Equity here is share capital paid up plus reserves and surpluses minus fictitious assets if any. Share capital paid up is 500,000. Then there is general reserve 150,000 and balance in profit loss account credit balance 372,300. There is no calls in arrears or fictitious assets. Therefore, capital employed is aggregate of the 3, 2,122,300. And method 2, capital employed is fixed assets plus net working capital. Fixed assets is 747,800. Current assets is 2,537,300 and current liabilities is 1,162,800. So net working capital is current assets minus current liabilities 1,374,500. Capital employed is fixed assets plus net working capital, that is 747,800 plus 1,374,500, that is 2,122,300. Thank you for your careful attention and sharing maximum.